How can we avoid a stock market crash in 2022? First, I feel like I have to address that there's going to be people that say, hey, the market goes up and down, and if it does go down, if it does crash, I'm just going to ride it out. It always comes back up. It always has. The market is at all-time highs. So it has obviously come back from every single market crash. Unfortunately, not everybody is in the position to be able to wait out a possible recovery depending on their personal situation. Just looking back at history, you can see at the beginning of the 2000s, we remember the dot-com bubble, so we know that there was a market crash there. And the argument is, sure, it's come back, so what do we have to worry about? Except that took from approximately August of 2000 all the way back to October of 2007 before you would have recovered all that was lost. Now, we know in October 2007, we were also peaking again, and then there was another crash in the markets to where we didn't come back from that until approximately mid-2013. So if you are riding these ebbs and flows and you need this money to live off of, you're approaching retirement, you may be in retirement, 13 years from 2000 to 2013, that's a long time. I think there is some validity to be concerned if there is an upcoming market crash. I think there's three main ways that you can buffer any losses or eliminate losses and avoid a market crash. So the first way to avoid a market crash is obviously take all your money out of the market. So if you're really conservative and this is a really big issue for you, yeah, it's, in my opinion, losing sleep's not worth it. If you have a lot of time before you need your money that's in the markets, or maybe you don't need it at all, then that doesn't make much sense to me. So think through it. But if this is money that you need, well, you could just take all that money out and just put it in the bank. So that is an option. However, that doesn't mean you're not going to be losing any of your money. I think the misconception is because I put the money in the bank that it's safe, but you're actually guaranteed to lose value by putting it in the bank, especially right now. Inflation. Inflation has been the highest that it's been since in the early 80s. So just last year in 2021, the inflation rate through November was 6.8%. I think we have to put that in perspective a little bit. Because if you take all of your money out of the market, you're not invested in anything. You're sitting in cash. If you had $100,000 at the beginning of 2021 sitting in your bank account, now, according to all the government numbers, which arguably aren't the best numbers to be using, your $100,000 is really no longer worth $100,000. You can't buy $100,000 worth of things. It's devalued 6%, which means now you can only buy $94,000 worth of things, which is a big deal, especially if you are retired or on a fixed income. Having $100,000 in value go to $94,000 in value, mind you, that's only over 12-month period, is arguably not that safe. What if the inflation rate stays this way for the next couple of years? It's possible that this sort of trend continues. We've been having a lot of stimulus, and it's made a major impact. And so if inflation isn't curbed and it continues, and if it were to happen 3 years in a row, you're getting into the low 80% range of what you were able to purchase previously. So understandably, you may be in a position where you want to keep your money safer. But realize that even keeping your money in all cash is not risk-free, because you lose value during inflationary periods, which unfortunately we're in now in a way we haven't been in 30 years, 40 years. Now, the second thing that you can do is to allocate your money towards things that gain value in the event of a market turn. or what most advisors will do, would be to have an asset allocation that is much more conservative. So you don't take all of your money out of the stock market. You keep a portion of it in, but you also put portions of your money in other things, especially in the things that increase in value when the stock market goes down in value, which typically are bonds and some fixed assets like gold. The third way to avoid a market crash, actually, I had three, I'm going to give you four. So one I just thought of is to avoid a market crash is to put your money at something. Insurance companies have products that guarantee to not lose funds in the event of a market downturn. So there are insurance products. Annuities is something that I'm thinking of currently, but you can put your money into an insurance product, and that way you're getting some sort of return on your money, but you're guaranteed not to lose any. As a fair warning, I'm not a big fan for the most part, especially of the annuity market currently. But if you do decide this is a way that you want to go, you want to make sure you understand the fees associated in the event that you change your mind. So this is one of my biggest pet peeves about the industry, because you don't really see any of the costs. A lot of it's really hidden. And although it may be a really good fit for you, what I've found is the fees of getting out of such investments are astronomically high, and people tend to change their minds over the years on what they want to do with their money, and by locking it up into something to where you get an enormous fee for taking it out, just can leave a bad taste in your mouth. So be careful when you're committing to something like that long term. Although there are those advantages to not losing money if the market crashes. Also, the concern of mine would be that the returns may not, even in the best years, may not keep up with inflation either. The fourth and final thing to avoid a market crash is something that I do for my clients. Is something that I think fits a lot of people's portfolios, is to not sell your portfolio, to not sell the stocks that you have, but to protect them with a layer of options. And this is a little bit more sophisticated, but you can protect your portfolio by purchasing put options. And it can be expensive if it's not done right, but you essentially are purchasing contracts that you're able to sell your stocks or your market positions at a certain price, so you know what your possible loss could be. So if the market does take a massive hit, something out of the blue comes, you have that extra layer of protection. And depending on how you do it, you may not lose any money if the market crashes, or even make money if the market crashes, but usually you will position your put option portfolio in a way that gives you a solid layer of protection in the event of a market crash. I feel like that's a lot of stuff. I hope that's helpful. Nobody knows what's going to happen to the market. Everybody's got an opinion, and it really doesn't matter. Even the smartest people are wrong a lot of the times. But just make sure you are in a position to hold the amount of risk that you feel comfortable. And if you're not sure where you should be at or how much of your money should be allocated towards different investments, find an advisor, find somebody who knows what they're talking about and can help you make those decisions and put you in a position that sets you up for your future. So anyways, hopefully that's helpful, and see you in the next video.